Welcome to Iron Financial, the forge where we hammer out market weakness to help you build a stronger portfolio. Today, Twilio, ticker TWLO, is on the anvil. Now, the company just dropped its Q4 and full year 2025 earnings. And let me tell you, the headline numbers look like freshly forged steel. They're strong, they're shiny, and they look absolutely flawless. But here's the catch. In a market that demands perfection and punishes any tiny hint of weakness, the stock just sat there. It barely moved. And that disconnect, that's exactly why we're here today. Our job is to run a full financial stress test. We're going to heat this company up, hammer on its weak points, and see if it has a solid iron foundation or if there are some hairline cracks that could shatter under pressure. Let's fire up the forge.
So this is the central conflict, right? This is the entire reason we're doing this deep dive. On one hand, you have a company delivering a quarter that, honestly, by any historical measure, should have sent the stock flying. We're talking record revenue, incredible free cash flow, and a landmark achievement that changes the entire story, their first ever full year of GAAP profitability. Now, this isn't just an earnings beat, you understand. This is a fundamental shift in the company's DNA, from a growth at all costs, cash-burning machine to a disciplined, profitable powerhouse.
And yet, the stock traded down, closing at minus 0.2% on the day. The market, in its infinite and, let's be honest, often frustrating wisdom, essentially just shrugged. So the question we have to pound on, the reason we're doing this stress test, is pretty straightforward. Is Wall Street just asleep at the wheel here, completely missing a fundamental transformation? Or does it see something underneath that polished surface that the bulls are choosing to ignore? Is this a coiled spring ready to pop? Or is it a classic value trap, just dressed up in a pretty earnings report?
Okay, let's get into it, and we're starting with the heavy metal, the top line. Twilio posted a record, let me repeat that, a record $1.37 billion in revenue for the fourth quarter alone. Now, this isn't just a beat against what some analysts expected. This is a statement. It's a statement of market leadership, a statement of demand. It tells you that in our increasingly digital world, the need for their core services, the basic plumbing for communication between apps and their users, isn't just strong, it's actually accelerating. In a tough macro environment where you see other software companies getting soft, this number alone sets a powerful, unshakable base for the entire bull case. Now let's talk about the quality of that revenue growth. 12% organic growth year over year. For anyone new to this, organic growth is the purest metric you can look at. Why? Because it strips out all the noise, the impact of acquisitions, currency swings, and it gives you a clean look at how the core engine is actually performing. Seeing double-digit organic growth in a company with an annual revenue run rate north of $5 billion is, frankly, deeply impressive. It shows their existing products are really gaining traction and that their sales engine isn't just running, it's firing on all cylinders. This is the heavy lifting that builds real, sustainable, long-term value.
And here it is, the milestone that changes everything. For years, and I mean years, the big knock on Twilio, like so many other high-growth tech darlings, was, yeah, great story, great growth, but can they ever make real money? Wall Street's graveyard is littered with companies that never made that leap. Well, 2025 was Twilio's definitive answer, a resounding yes. $158 million in GAAP net income. This is the transition from adolescence to adulthood. It signals a level of operational discipline, of financial rigor, that, as CEO Kazema Shipchandler put it on the call, has fundamentally transformed our financial profile. This isn't just a speculative growth play anymore. It's a profitable tech leader.
Okay, so if GAAP profit is the solid foundation, then free cash flow is the steel reinforcement holding it all together. And get this, a staggering 44% year-over-year growth, bringing in nearly $1 billion, $945 million to be exact, in free cash for the year. This is the lifeblood of a company. This is the cash that allows them to aggressively buy back shares, to pour money into R&D for their next-gen products like AI, and to weather any economic storm without even breaking a sweat. On the surface, this company isn't just strong, it's a cash-generating fortress. It looks absolutely impenetrable. Whoa, hold on. Before we declare this company is built of solid iron and crown them the victors, let's talk about the rust. The market saw all those beautiful, shiny headline numbers, and the stock still ended the day in the red. Why? Because the market is a forward-looking machine, and it looks right past the headlines to the fine print. And it sees a price-to-earnings ratio of nearly 270. Now, to put that in perspective for you, a mature, stable company might trade at 20 times earnings. A high-growth superstar might earn a multiple of 50 or 60. 270 is a valuation that demands perfection and absolutely explosive future growth, not just good past performance.
And the market also sees reports from places like MarketBeat pointing to notable insider selling. So while the bulls are standing there admiring the fortress walls, the skeptics are asking, why are the people inside, the ones with the most information, selling their shares? And is the price of admission to this fortress just way too high? And that's exactly what we're here to figure out. So here's our blueprint for today's stress test. We've seen the impressive headlines. Now we're going to forge deeper, starting with a granular look at that top-line growth. Then, we'll put the company's profitability claims under some intense pressure. We will scrutinize their guidance for the future. We're going to actively hunt for any cracks in the armor. And finally, we'll weigh all the evidence to deliver the iron verdict. Let's get to it.
Okay, Section 1, Forging Top-Line Growth. Any company's long-term strength starts and ends with its revenue engine. The question is it a fragile single-piston motor that's overly reliant on just one product, or is it a multi-cylinder beast with diversified power sources? We need to look under the hood here and see precisely where that 12% organic growth is coming from and figure out if it's built to last for the next 5 years, not just the last 5 months.
And this slide perfectly illustrates the point. This is taken directly from Twilio's own investor presentation, and what it shows is a diversified, high-performance engine just firing on multiple cylinders. Just look at this. You've got 24% growth in ISV revenue. That's independent software vendors building their own products right on top of Twilio's platform, which is an incredibly sticky business model. You've got 21% from self-serve customers, a 26% increase in customers using multiple products, which is a key indicator of deepening relationships. And look at the bottom right there, a 49% explosion in voice AI customers. This isn't just one part of the business doing all the heavy lifting. This is broad-based, synchronized strength. It shows they are successfully cross-selling and upselling, expanding their footprint within their most valuable customers.
The numbers are impressive, no doubt, but our job is to put them under the microscope, not just admire them. Messaging grew at 18%, and it's still, by a very wide margin, their largest single product. I mean, it accounts for almost 58% of all revenue. Now, the company itself admits in the risk factors of its own 10K that as messaging's share of the business grows, it could put downward pressure on the consolidated gross margins. So is this truly healthy diversification, or is the company actually becoming even more reliant on its biggest but lowest margin product line? And yeah, that voice AI growth of over 60% in Q4 is explosive, I'll grant you that, but it's coming off a tiny base. We have to question the sustainability. Can they keep that kind of momentum going? Or are these just blowout numbers from one great quarter that will be impossible to replicate?
So the crucial point is how they sustain it, right? And the answer is right here on this slide. They sustain it by moving up the food chain from being just another vendor to being a true partner. Look at these Q4 customer wins. They signed the single largest deal in the company's entire history, a 9-figure renewal. That's not a transactional purchase of text message capacity. That's a deep structural multi-year partnership. They're winning these strategic deals with innovative, fast-growing companies like Ramp for next-gen messaging and Sierra for AI voice platforms. As the executive team said on the call, they're successfully shifting from selling features to selling solutions. These aren't just one-off deals. This is proof that Twilio's embedding itself as the foundational communications infrastructure for major enterprises, which makes for much stickier, more predictable, and higher-value revenue.
All right, let's move to the next section and see how this all stacks up. This is where the story gets really complicated, and honestly where the bull and bear cases really collide. So the company's flashing these huge, impressive free cash flow numbers, which is great, but at the same time, when you look closer at the actual margins, the profitability of each dollar of revenue, you start to see some really concerning pressure. It's a battle between pure cash generation and the quality of each dollar earned. This is the core of our profitability stress test. And the cash generation is simply undeniable. I mean, look at this chart. Free cash flow surged dramatically through 2025. They ended the year with a strong 19% free cash flow margin and, like we said, 44% year-over-year growth. That's $945 million in cash. And they're using it aggressively to reward their shareholders. They bought back $855 million worth of stock last year alone. That's 90% of their free cash flow, absolutely smashing their stated target of returning 50%. This isn't just accounting profit that can be manipulated. This is cold, hard cash hitting the balance sheet, and management is showing immense confidence by using it to directly reward shareholders and shrink the share count. But here's the counterpunch. While all that cash is flooding in, the profitability of each individual sale is actually shrinking. Their non-GAAP gross margin fell by a full 200 basis points year over year. It dropped from 51.9% all the way down to 49.9%. For a software-adjacent company, falling below that 50% mark is a huge psychological red flag for investors. It makes you ask, what good is record revenue if you're making less profit on every single dollar you bring in? This isn't a minor rounding error. This is a significant crack, and we need to understand exactly what's causing it. And management was very clear on the culprit. This margin compression is almost entirely because of increased carrier pass-through fees. These are fees from carriers like Verizon and T-Mobile for what's called A2P, or application-to-person messaging. In Q4 alone, these fees cost them an extra $23 million. Now, the company argues these are essentially a tax. They are pass-through costs that don't impact the actual profit dollars or the free cash flow. They just have to collect the fee from their customer and pass it directly onto the carrier, which artificially deflates the gross margin percentage, but not the gross profit dollars. Okay, I understand the accounting argument, but calling it a pass-through doesn't make the business problem just disappear. It shows a fundamental lack of pricing power. If a key supplier, in this case a massive telecom carrier, can unilaterally raise your costs and you can't or won't pass that entire cost onto your end customer to maintain your margin, that points to a structural weakness in your business model. It suggests you're a price taker, not a price maker. So the critical question for the long-term health of this company becomes, is this a one-time thing, or is Twilio's profitability just permanently at the mercy of the big carriers?
And that question leads us directly into our next section, the future guidance. Management has laid out its blueprint for 2026. This is their promise to Wall Street, their forecast of what's coming. We need to analyze this plan meticulously to see if it's built on solid ground or if it's telegraphing a significant and potentially dangerous slowdown.
Exactly. Guidance is where the rubber meets the road. All the success of 2025 is in the rearview mirror now. What really matters for the stock price today is whether they can keep that momentum going tomorrow. Let's see what they're promising.
And the promises are big. For the full year 2026, they are guiding to over $1 billion in non-GAAP operating income and over $1 billion in free cash flow. Just think about that for a second. They are explicitly telling the market they will be a cash machine, converting virtually every single dollar of operating profit directly into free cash. The CFO, Aidan Viggiano, also made a point to highlight that the Q1 organic growth guide of 10 to 11% is the highest it has been for us in 3 years. This isn't some timid, sandbagging guidance. This is a confident projection of continued operational excellence and powerful financial discipline.
But you have to look at the whole picture, not just the cherry-picked highlights. That strong Q1 guidance quickly fades as the year goes on. This chart right here, this shows the real story the market is worried about. Full year 2025 organic growth was 13%. The guidance for full year 2026 is only 8 to 9%. That is a significant deceleration of 400 to 500 basis points. So, after a year of accelerating growth and transforming the business, management is now telling us to expect a material slowdown. The billion-dollar question for investors is this: is the hypergrowth phase officially over? Are we now looking at a mature, slower-growing company? Because if that's the case, that 270 PE ratio looks even more unsustainable and, frankly, dangerous.
And that brings us to the part of the stress test where we really consolidate all the risks. We've acknowledged the company's strength for sure, but now it's time to hammer on the potential weak points. Let's identify every crack in the armor, the extreme valuation, the questionable insider selling, and the persistent headwinds that could threaten this entire investment thesis. Let's start with the most glaring issue, the valuation. The price-to-earnings ratio tells you how much investors are willing to pay for $1 of a company's earnings. The S&P 500 average is around 25. Twilio's is nearly 270. Yes, I know, they just turned profitable, which makes the number volatile and a little less reliable in the short term. But this is a valuation that is typically reserved for companies with explosive 30-40% year-over-year growth, baked in for years to come. With management themselves guiding for organic growth to slow to high single digits, a PE of 269 feels less like optimism and more like a complete disconnect from financial reality. How can anyone justify that price? Then there's this, market beat, flatly stated after earnings that there has been notable insider selling. Now look, insiders sell shares for a lot of reasons: diversification, buying a house, tax planning, and you shouldn't panic over a single sale. But when you see a consistent pattern of selling from multiple executives, especially after the stock prices run up, it becomes a significant yellow flag. The people with the most intimate knowledge of the company's day-to-day operations and future prospects are reducing their exposure. As an outside investor, you have to ask a simple, logical question. If they're selling, why should I be buying? And finally, that margin problem isn't going away. This wasn't a one-quarter anomaly.
Management has baked the issue right into their 2026 forecast. They explicitly stated on the earnings call that they expect these pass-through fees to reduce their full-year 2026 non-GAAP gross margin by another 170 basis points. So the significant margin compression we just saw is not only continuing, it's guaranteed to happen again. This just confirms that it's a persistent headwind and a structural feature of their business model, not some temporary bug they can easily fix.
Okay, we've run the tests. We've examined the revenue engine, we've stress-tested the profitability claims, and we've inspected the foundation for any and all cracks we could find. It's time to weigh all the evidence. We've laid out the comprehensive bull case and the compelling bear case. Now it's time for the iron verdict. Is Twilio a massive opportunity hiding in plain sight? Or is it a value trap just waiting for unsuspecting investors? Look, the bull case is forged from tangible, powerful, undeniable results. This is a newly GAAP profitable company generating massive and growing free cash flow. They aren't just hoarding this cash, they are returning it to shareholders aggressively with buybacks. Growth in key strategic areas like voice AI and enterprise deals is exploding, and they're signing larger, more strategic partnerships, making the revenue stickier and more predictable. This company has fundamentally and successfully transformed its financial profile. It is now built on a solid iron core of profitability.
But the cracks are real, and they're impossible to ignore. Management's own guidance, their own forecast, points to a significant slowdown in organic growth. The gross margin, which is a key indicator of profitability, is being structurally compressed by outside forces that they just can't seem to fully control. The valuation is sky high, pricing in a level of growth that the company itself is not projecting for next year. And that pattern of insider selling suggests that those closest to the company might agree that the stock is fully valued, if not overvalued at these levels. These aren't minor imperfections. They are potential points of failure under economic stress.
And that is the final, critical question we leave you with. There is absolutely no doubt that Twilio has successfully forged a new foundation based on profitability and cash generation, and that's a truly impressive operational feat. The structure of the company is stronger than it has ever been. But the market's hesitation is palpable, and maybe it's justifiable. It sees the slowing growth engine and the towering valuation, and it asks if the price of this fortress is simply too high for the growth it promises to deliver. Is this the moment to buy into a newly disciplined cash cow before the rest of the market catches on, or is it a time for extreme caution? That's the decision you have to make for your portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.